It's Ryan Detrick is Carson Group Chief Market Strategist. Sounds to me as, thank you for coming back. Much of the same story. This bull market rolls on.
Yeah, we think so, Scott. Thanks for having me back. Happy long weekend, everyone, and good luck if you're trying to win $1 billion in Powerball this weekend. Listen, overall, we're still bullish, yes, but I do want to talk about September for a second because I know lots of people are going to be pointing this stuff out. Since 1950, it is the worst month on average. The last 10 years, again, the worst month. The last 20 years, the worst month. And in a post-election year, it's like the third worst month. Now, one more thing to think about. I get it. August obviously was higher. This will be the first time August was higher with a second-term president going back to like World War II. But it is rare, Scott, to see August and September both higher in a post-election year. It's only happened 3 times going back to the last 18, 4-year cycles. So we're still in a bull market, yes, but I wouldn't be shocked if we had a little bit of kind of seasonal weakness, and we can get into kind of why. But I think it's possible after a 30% rally in a 4-month win streak here.
I know, but in all of that, including the wishing good luck for the Powerball and all that, I don't think I heard a reason as to why the market's going to continue to go up into the fall. Why September won't have a historical repeat.
Yeah, well, listen, I'm a big message of the markets person, right? Like, what's the market telling us? Well, if you look at kind of the leadership, I love it. What's even lagging, I even like more. Look at Staples. Staples relative to the S&P 500 is making like new lows right now. You want that area to lag. On the offensive side, you've got like high beta, some of those things doing very, very well. Obviously, consumer discretionary relative to Staples. So the message is still very solid. Now, one more thing. I know last week I didn't get to join you, but last week was a 90-90 day. Meaning 90% of the stocks, this is last Friday, 90% of the stocks on the New York Stock Exchange were higher and 90% of the volume. That is extremely rare. Going back to 1980, it's only happened 12 other times, Scott. A year later, S&P is up 11 times and up over 20% on average, even stronger returns in the near term. So if we have a little seasonal weakness after a 30% rally, I think it's going to be contained, say 4 to 6%. And there's still a lot of reasons the underlying pinnings that got us to this bull market are still healthy.
So you don't really buy the broadening, it sounds. I mean, beyond what we've already had from a big cap standpoint. If you want us to stay overweight industrials, financials, and technology, in other words, stay the course, don't overcomplicate it?
That's right. I know small caps had a heck of a rally. We get it. But, Amarosa and you just had a great discussion about kind of the PC. I'll take the other side of this. We're a little more concerned. Anastasia, sorry. We're taking the other side of this, though. If you look at like 178 components of core PCE, 45% of them are above 3%. What in the world does that mean? It was 40% at the start of the year. So we are seeing more of a broadening out on inflation. So what I'm getting at, the Fed's probably going to cut a couple times. We know that's coming. Maybe they don't cut the 6 times that are priced in over the next 16 months because inflation's a little higher. And what does that mean? Well, probably stick with who brought you to the dance, those large caps and, again, industrials, financials. And small caps are an area we have exposure, yes, but we're not overweight small and mid caps here.
Does the Fed cut in 2.5 weeks?
Yeah, we think so. We think so. And you had some other great discussions before I came on. I think the stage is set there because they kind of have to, I think, for lack of a better word. We were the camp, I think I came on earlier this year, saying they should have been cutting back in the first quarter. Then they didn't. Then tariffs happened. But, there are some worrisome parts of inflation. But the reality is, yes, the labor market is obviously weakening, as everyone's been talking about. So it makes sense. We don't need 4.5% interest rates right here, Scott. We think, probably 2 more cuts this year, and then we'll see what happens next year.